Welcome to Talk Tickers. We give you the quick hit summary of the quarter's most important earnings calls, actionable context, without all the filler.
Yeah, and today we're diving into PACCAR, that's PCAR, looking at their Q3 2025 results.
Our goal here is really to get past just the headline numbers.
Exactly. We want to dissect the Q3 performance. It was a bit mixed, but the market seemed to like it overall, and we need to figure out the strategy, especially with that big regulatory shift coming for trucks.
Looking for the competitive edge, basically.
You got it.
Okay, so let's start with that mix. It really was a classic mixed print, wasn't it? You had the headline earnings miss.
GAAP EPS, $1.12. Analysts were looking for, $1.14 to $1.17. So a miss there. And a big drop from $1.85 last year.
Right, but then revenue resilience, that shone through. $6.67 billion, beating expectations, which were kind of in the $6.6 billion range.
Yeah, beat the top end of the range, even though it was down 19% year over year.
So the stock trades up on the day, up about 1.2%. That tells you the market was definitely focused somewhere else, not on that EPS miss.
Absolutely. I mean, the core truck market is still pretty soft. Global deliveries were down. That's why total revenue dropped year on year.
But hitting $6.67 billion despite that softness and beating the street, it kind of makes you wonder, okay, if profit was down but revenue beat, how solid is the underlying business?
And management's answer, their framing was that the results were actually good. And that strength came from two key areas providing stability. Ballast segments, you could call them.
Anchors, right. Holding things steady while truck sales are weaker.
Precisely. First one, PACCAR Parts. Just keeps delivering. Record quarterly revenue again, $1.72 billion. That's up 4% year over year.
Up 4% when the overall truck market is down. That's impressive.
It really is. And strong pre-tax income, too, $410 million. It's like an annuity, you know? When people aren't buying new trucks or fixing the old ones, that's where the stability comes from.
Okay, and the second anchor?
PACCAR Financial Services, PFS. They posted $126.2 million in pre-tax income, which suggests they've got a high-quality loan book and they're doing well on used trucks.
Which can sometimes be a leading indicator for new truck demand later on, right? Good used market helps trade-ins.
Potentially, yeah. So the market looked at that $1.72 billion in parts revenue, almost a quarter of their total sales, and sticky high-margin revenue at that, and the solid PFS numbers, and basically decided the core business is weathering this cyclical trough much better than maybe feared.
So the EPS miss was seen as, temporary? Noise?
More or less. Transient noise, overshadowed by the resilience in parts and finance, and crucially, the forward guidance, which we'll get to.
Okay, let's connect this to margins then. Usually a weaker cycle means lower margins. Q3 gross margins were 12.5% for truck, parts, and other combined.
Right. And management was pretty clear, blaming earlier steel and aluminum tariff increases for hitting them in Q3.
But the key thing isn't just Q3 margin, it's where the bottom is, right? The trough.
Exactly. And they guided Q4 gross margins to dip just slightly, to about 12%. They specifically said the current tariff costs are expected to peak right now, basically in October.
So Q4, especially October, is the low point. Knowing that makes it less scary if you know things get better right after.
And we do know why things get better, which brings us to the really big strategic piece. Section 232.
Okay, Section 232. Sounds a bit technical. Break that down for us. How does that change the game for PACCAR?
Think of it less as just tariffs and more as a policy reinforcing domestic manufacturing for trucks sold in the U.S. It kicks in November 1st.
And PACCAR makes most of their U.S. sold trucks.
Well,
where?
Right here. Texas, Ohio, Washington, Peterbilt, and Kenworth. They said over 90% of the trucks they sell stateside are built stateside.
Okay.
So this Section 232 policy, it sets up a system like a rebate or an offset that basically cancels out the cost hit from certain tariffs if you manufacture domestically with a high percentage of U.S. content.
So if you're PACCAR with huge U.S. factories, this is a direct benefit. But if you're a competitor importing more trucks or major parts from, say, Europe,
it's a cost disadvantage for them, a structural one. PACCAR management flat out said this policy change will be good for our customers and brings clarity. It improves their competitive position.
So this isn't just a temporary tariff thing, it's a lasting advantage tied to their manufacturing footprint.
That's the key takeaway. It's structural. Now, they did say the full financial benefit won't hit all at once. It ramps up gradually.
Okay.
They expect it to achieve, sort of, stability and the full effect by early 2026. And that's why Q4's 12% margin is seen as the trough. It's the dip just before these Section 232 benefits really start kicking in and offsetting those peak October costs.
Got it. And that clarity, that structural advantage, lets them change how they talk about pricing, too.
Yeah, exactly. They mentioned wanting to move away from adding those separate tariff surcharges, which they said were running about $3,500 to $4,000 per truck. Now they could just bake it into normalized truck pricing.
Which must be a relief for customers, too. More predictability.
Definitely. And when you offer stability and you have a structural cost edge over competitors relying more on imports, you're setting yourself up nicely to gain market share when the cycle turns up again.
Speaking of the next cycle, PACCAR isn't pulling back on investment even now.
Not at all. They're maintaining pretty high investment levels. 2025 CapEx guidance is $750 to $775 million. R&D is $450 to $465 million.
And 2026 looks similar.
Yeah, they signaled similar ranges for 2026 too. That money's going into the expected places. Clean diesel, alternative powertrains, think electric, hydrogen ADS, connected vehicle tech. They're definitely positioning for what comes next.
And on the product front, they're not just waiting for the future.
Nope. They launched the Kenworth T880S. It targets that premium high horsepower vocational segment. We're talking up to 605 horsepower, over 2,000 pound-feet of torque. That's for tough jobs where power matters.
So investing in current high-margin segments while building the EV future in parallel, like the battery JV.
Exactly. The Amplify Cell Technologies JV with Cummins and Daimler Truck, that's moving ahead. Building the factory in Mississippi, targeting actual cell production starting in 2028. It's a measured, long-term play on electrification.
Okay, let's shift to the demand outlook. This seems like the big wild card, especially looking out to 2026. What's the guidance for North American Class 8 trucks?
So for this year, 2025, it's pretty steady. They're guiding 230,000 to 245,000 units for Class 8 retail sales in North America.
Okay, relatively tight range. But 2026?
That's where it gets interesting. A really wide range, 230,000 all the way to 270,000 units. That's a 40,000 unit spread. Huge uncertainty baked in there.
Wow, 40,000 units. What's the single biggest thing driving that massive potential swing?
It boils down almost entirely to the EPA 2027 emission standards, specifically around NOx nitrogen oxide. The rule that's currently on the books for 2027 model year trucks, which means trucks bought in late 2026, is really tough. 35 milligrams NOx.
And why does a tough standard in 27 drive buying in 26? Explain that pre-buy dynamic.
Okay, so if that 35 milligram standard sticks, manufacturers will need significant, expensive, and frankly still somewhat unproven engine and after-treatment system changes. Fleets hate buying brand new, unproven tech, especially if it might hurt fuel economy or add maintenance complexity.
Right, the don't buy the first model year rule, writ large.
Exactly. So if that tough rule stays, fleets will rush to buy the 2026 models, which meet the current less stringent standards before the new rule hits. They'll pre-buy ahead of the change. And that huge wave of pre-buying pushes the 2026 market way up towards the high end of that range, the 270,000 units.
Okay, so conversely, if the EPA changes course, maybe relaxes the standard back towards something easier, say 200 milligrams.
Then the urgency disappears. That pre-buy wave just wouldn't happen. Demand would be much more normal, driven by regular replacement needs. That likely puts the market down towards the lower end, maybe 230K to 250K units.
So the fate of that 35 milligram rule is basically the key to unlocking whether 2026 is a boom year or just another year.
Pretty much. And the clock is ticking. The longer that rule stays confirmed, the more likely that 270K scenario becomes.
Okay, beyond the regulatory cloud, what about just basic freight demand? The freight recession's been dragging on, but are parts of the market holding up?
Yeah, they are. Management highlighted stability in vocational think construction trucks, utility trucks, and also less than truckload LTL. LTL tends to be a bit more stable, more contract-based.
And those segments are probably taking advantage of things like bonus depreciation incentives too.
Definitely. They mentioned those buyers are using the 100% bonus depreciation. But the elephant in the room is still truckload.
The biggest segment, right? About 40% of the market.
Yep. And it's been, let's just say, tough for well over 2 years now, 30 plus months.
But there has to be a replacement cycle eventually. Trucks don't last forever.
That's the hope. Management thinks that the aging fleet, plus some regulatory nudges, has to drive replacement demand eventually. That could provide a significant lift, especially heading into 2026, even if the freight market itself doesn't boom.
And that aging fleet directly fuels the parts business we talked about earlier, doesn't it?
Absolutely. It's the perfect hedge. Fewer new trucks sold, means more old trucks needing parts and service. That 4% parts growth, while the new truck market is negative, that's proof right there, the older fleet is driving that aftermarket demand. It really reinforces the foundational profitability, as they put it.
And they're investing in parts capacity, too, new distribution centers.
Yeah, they mentioned a new center opening in Calgary and expanding engine remanufacturing down in Mississippi, leaning into that strength.
Okay, so you've got this strong parts business and this new Section 232 advantage. Did PACCAR say if they actually have the factory capacity to handle potential market share gains?
They did address that, confirmed that recent investments, particularly at the Denton, Texas Peterbilt plant and the Kenworth plant in Chillicothe, Ohio, give them ample capacity. They feel ready to handle share gains if they materialize.
Their current share is around 30%, right? Peterbilt and Kenworth combined.
Yeah, 30.3% currently. The Section 232 cost advantage is definitely aimed at pushing that higher.
All right, let's shift gears. Time for our This Is Not Financial Advice segment. We take what we've learned and pitch a, let's say, bold but potentially plausible trade idea just for discussion.
Okay. The theme today is what we're calling the buy the trough, premium for clarity long trade on PACCAR.
Okay, lay out the premise. Why PACCAR specifically?
Well, the stock, PCAR, has actually lagged the broader industrials ETF XLI over the past year. That suggests it's still being valued based on the current cyclical weakness and maybe not fully pricing in the positive strategic shifts.
So the idea is the market is too focused on the rearview mirror?
Kind of. We know Q4's 12% gross margin is likely the bottom, right?
Right.
Driven by those temporary October tariff costs that Section 232 should then help offset. The market looked past the Q3 EPS miss because it saw two stronger signals. One, that record sticky high-margin parts revenue. It's almost like a subscription business. And two, the big one, the new clear structural competitive advantage from Section 232 favoring their U.S. manufacturing footprint. That's clarity the market likes.
Okay, so if you believe that, how do you treat it? How do you isolate the PACCAR story?
The idea would be to go long PACCAR stock, but hedge out the general market or industrial sector risk. So you could fund the PACCAR long by simultaneously shorting a broad industrial index ETF like XLI.
Ah, a pairs trade. Long PCAR, short XLI.
Exactly. You're trying to isolate the bet on PACCAR's specific situation, the margin recovery off the Q4 trough driven by Section 232, and the potential for share gains from that U.S. manufacturing cost advantage. You neutralize the risk that the whole industrial sector just keeps going down.
So you're betting on PACCAR's multiple re-rating as margins climb back up. Maybe back above, say, 14% where they might have been without the Q3 tariff hit.
That's the thesis. You're betting that clarity on the margin trough and the structural advantage deserves a better valuation relative to the rest of the potentially struggling industrial sector.
What's the biggest risk to that trade? Where could it go wrong? Shorting the index feels like you're betting against the whole economy to some extent.
The main risk is that the Section 232 benefit isn't as big or doesn't materialize as quickly as expected. Or maybe the truckload recession just keeps dragging on, and it eventually does start to pull down even the resilient parts business more than anticipated. But fundamentally, the trade rests on that policy certainty, creating a real, measurable cost gap favoring PACCAR.
Interesting. A trade based on policy clarity and manufacturing footprints.
Right.
Okay, so let's recap our deep dive on PACCAR's Q3. We had the EPS miss, but a revenue beat.
Driven by that foundational rock, the parts business, providing stability.
And the big strategic story, Section 232 giving them a clear competitive advantage and visibility on the margin trough heading into 2026.
Which leads us to the final provocative thought for you, the listener, to chew on. The market seems to be valuing PACCAR based on this 2025 trough and all that regulatory uncertainty for 26.
Right, that huge 230K to 270K unit range.
So the crucial question is, what's the primary catalyst that pushes the 2026 market to the high end of that range, to 270,000 units? Is it the EPA sticking with that tough 35 milligram NOx standard, forcing the pre-buy? Or is it an actual fundamental recovery in that truckload segment that's been suffering for nearly 3 years now?
Which one matters more for hitting that top number? That's the key uncertainty for anyone allocating capital here. Something to definitely keep tracking. Thanks for diving deep with us today on Talk Tiggers.